Hi, I'm Peter Rose, founder of Longwood Currency Trading. How do you simplify your trade entry? This is a topic that comes up constantly. Folks emailing me. In fact, I'd like to send a shout out to my friend CY in Australia, who actually brought the topic out of how do I simplify this process a little bit more? What's really involved? Talking about opportunities to trade. How many times do you have an opportunity to trade? Because I've said in the last several videos of mine that I can take a look at the charts and in a very short period of time determine whether there's a trade to be had, whether it's worth sitting down at the desk and trading or not. I've said it takes me 15 seconds. Most of the time it does, because I have a very simple set of rules. But CY had kind of settled in on a couple of aspects of that. Well, how many trades can I expect that are going to occur on a daily basis? And there's some factors that are really involved in answering that particular question as to the expectation as traders that we have as to how we're going to get to trade today. How many times are we going to get to trade? So, CY, thanks for the question. And as I started out to chat with him in my reply email, I don't know whether I mentioned specifically or not, but currencies themselves are different. The price action is different, and the structure behind what causes that price action is different than the stock market. And in fact, those differences make it much simpler in order to create, to create simple rules. And the reason for the simpler rules is simply because you're dealing with such a massive market with countries behind, economies of countries behind how that price action moves, as opposed to dealing with an individual stock. And you got to know what its price earnings ratio is, and whether the CEO is a convicted felon, or whether sales are going to meet profit targets, and whether there's a customer revolt going on. And so you have all these considerations that come into evaluating the stock market. You really do have a lot of work to do, and many of the indicators that those folks who have done stock trading before and that bring into currency tradings, those types of indicators tend to work better in that stock market environment, simply because of the structure of the market itself. Whereas you can come into the currency market and none of that makes any sense. There's no reason for it. And I've said that I don't trade by using indicators at all. I'm a price action trader. And there's a reason for not using indicators, and one of them is because they don't work, and because they work in the stock market but not in the currency market. And that's why my consulting or discussions about the currency market emphasize the need to really analyze what the market is itself in order to determine what those simple rules are. So not only does the creation of rules become much easier and are more straightforward in the currency market than in the stock markets, for example, but also it makes for a much faster entry decision process. I don't have to go through a 42-item check-off of not only what that one particular stock is doing, but the stocks in that industry group and what the Dow Jones or the S&P or whatever, what they're all doing, and the correlation between the S&P and the Dow, and what the interest rates are, and whether there's chaos in the streets or whatever. You don't have to look at all that stuff. What you see in the currency market is what you get. And if you understand that, and if you understand what that market structure is, then you don't have a whole lot of things to look at in determining whether there's a trade entry. And so because of that, and I'm a day trader, because I want to be able to do whatever I'm going to do as far as trading goes, and then get on with my day. And the folks that I am working with, they all have jobs. I think maybe one person is retired or has a job they can work from home and they're not beholden to anything, but you got a job, and so you can't sit there all day. And I feel that if you do a set and forget, let's say you're trading off the daily chart, and so you look at it at 5 o'clock at night, and you make your trading decisions, you wake up in the morning, see what's going on with the open, and make your trade and go to work. And I don't know, what are you going to do, something at the end of the day? Not if you're trading on the daily chart. You're going to set and forget that. That's gonna go for weeks. And that's why when I teach currency trading, it's down on the lower time frames, because there's more opportunities to do evaluations so that you get really good at it. It's like if you were practicing tennis. You wouldn't want to go out on the court and hit the ball once and then go home and come back the next day and hit the ball again. You wouldn't get any good at tennis. You want to get down there on the tennis court, you want to hit that ball, hit that ball, hit that ball for hours. The famous golfer Lee Trevino said, every day, no matter what the day is, it could be raining, it could be Saturday, it could be my birthday, it doesn't matter. I'm going to go out and I'm going to hit the ball 1,000 times. So that when I step up to the tee in a competition, I know where my ball is going. My competitors only think they know where their ball is going. And I think there's a lot to be said for that. In fact, a very well-known and respected trader says, trade small and trade a lot. And so why? Because not only do you learn a lot, but you also get so used to making those decisions that the whole thing coalesces together and you just go, it's a trade, I'm in. You don't have to think about it. Speculators who are grabbing 3 pips here and 2 pips there and going in and out all day, maybe making, when I scalp, I've done as many as I think, I don't know, 25. I think I did 25 positions in a day. And there are scalpers that could do 100. Whatever, you learn an awful lot. And your experience level goes up very, very quickly. And so that's why when I am presenting my material, when I'm talking about the material in trading, when I'm working with someone as a student, it's going to be down on that 5-minute chart. That's a great chart. You have 12 opportunities an hour in order to determine whether you have a trade event or not. When you go up in time frame looking at different charts, you have an arithmetic series of declining opportunities to look at for trade opportunities. So on a 5-minute chart, you've got 12 opportunities an hour, right? If you're on a 15-minute chart, you've got 4 opportunities an hour to look at that chart. If you're on an hourly chart, you got 1 opportunity an hour to determine if there's an opportunity to trade. So the higher in time frame you go, the less opportunity you have of looking at whether you want to trade or not. And quite frankly, if you have less than a couple of years of trading, you shouldn't be doing long-term trading because you don't have the experience to look that far ahead in the currency markets, particularly to say, oh, in 3 weeks, I think price is going to be here. You don't know where price is going to be tomorrow in currencies. And because of the ATR of the larger time frames, if you're on a daily, you're 100 pips, the thing could go 200 pips against you. So what are you going to do? Set your entry stop at 200 pips, and you've got a 400 pip profit target. So the stupid risk to reward ratio, you get 400 pip profit, and I'm taking a 200 risk. I'm a 1 and 2 risk to reward. I'm in great shape. That shit don't float. It just doesn't make any sense. It's stupid. It's stupid in currencies. It's stupid in any kind of trading, financial trading that you do. And I'm not going to get into that here because we're talking about entry theory. But what I'm trying to emphasize is that in order to simplify your life, you have to become good at trading. The only way you're going to become good at trading is by trading. And so you get a lot of trading if you're down on the 5-minute chart, because you have 12 opportunities an hour to decide whether you want to trade or not, or whether you want to stage into an existing position or not. And in a 2-hour period of time, you should be able to get a trade and be done with it. I mean, how long are you going to sit there with that trade to hit your profit target? On a 5-minute chart with a period of 5 pip ATR, I'm looking at profit targets of about 20 pips if I'm an all-in, all-out trader. If I'm going to be building a position, or I'm going to be staging in because I see a longer-term characteristic for the trader, then to get into the trade for profit target, I'll set that 30 or 40 pips up. I've got to have that much real estate in order for the price to move up far enough so that the bulk of the position that I build at the lower parts, I can protect that with a floating stop or a trailing stop. And then if price moves up 10 pips and it starts to agitate or whatever, I'll pull the plug and get out, and then I'll go to work. But if that price goes up 10, 20 pips and it's still going to go, I can throw a trailing stop on it and go to work. The danger of doing that is that trailing stop might be 10 pips below the last closing candle, and so you have a candle that closes at 10 pips, and then your next candle goes up, and so your stop then is at that 10 level, $10 level or whatever it is, and it goes up and it goes up, and then it comes down 20 pips. So you're 10 pips or 15 pips or 20 pips below that target point. But eventually maybe that's going to turn around and go up. Based on the price action that's going on at that advanced candle, you're not there to judge that, to say, you know what, I don't care how far that that thing can come 50 pips back. It's not going to take out maybe 50 pips down. It would be within 10 or 12 pips of my average position value, and so I'm going to get 12 pips on 10 lots. I'm good with that. I'm good with that, with a $1,200 gain. So I'll let that price come down 30 or 40 pips. Whereas if you get a set of trailing stop, you're not going to set the trailing stop there. It's going to be like at 20 pips. So you're not going to be there for that turn, and you'll get stopped out. And then price will turn around and it'll go up 200 or 300 pips, and you wouldn't have been there to catch it. So you're not making, for the risk that you're taking, you're not making the dollar value that you should really be making for the risk that you're taking, right? And that's just the mathematics of it. I've got a degree in physics, almost a minor in math. I understand the math of this stuff. I was in real estate for 40 years. I get it. I understand this stuff. And this is how I work with my students. Let's look at reality here. What are you trying to accomplish? So if you learn how to trade on the lower time frames, you get all that decision-making process, you get the big picture of things, and then if you get a runner, then you know how to set your trailing stop. But if you are learning how to trade on the higher time frames, that trading process, all those theories and strategies are not valid down on the lower time frames. You get chewed up to death. And that's why so many people fail, because that's what they're taught. They're taught, oh, it's safer if you trade up on the daily chart. Sure, it's safer to trade up on the daily chart if you're trading a $400,000 or $500,000 account and you're taking less than 0.25% risk on the account, because it doesn't matter. You know, you get stopped out at 0.25% of the rise, and when you get the trade moving and you trail stop, and you got you're trading $300, $400, $500 a pip, and you make 10 pips. Holy crap! You make the $300, $3,000 to $5,000 in a very short period of time when the thing collapses on you on the long-term gains. And you're always hoping the thing is going to keep right on going up. Well, that's fine if you got a big account and you have a lot of experience, but those aren't appropriate trading methodologies that are going to transfer down onto the shorter time frames. That's why most traders frown on the shorter time frames, because they don't understand them. I work with people to make you understand the value of that short-term time frame and the learning capability and how to morph those rules that you learn on the shorter-term time frames up onto the higher time frame should you decide that you want to be a daily, you want to be a swing trader, or you want to be a long-term position trader. Those rules that you learn down on that 5-minute, 1-minute, 15-minute time frames, those are all transferable up, but it doesn't work the other way around. It doesn't. They just don't. I've been studying these markets since 2007. It's mid-June of 2023 right now. I'm just telling you the way that it is. So, in any event, there's a direct function in the simplicity of your trade entry guidelines when you are down on the lower time frame. And I've also mentioned that a lot of that has to do with where you're setting your profit target. What's your expectation? The distance that price has to go before you make your money for the day. On a 5-minute time frame, if you've got a price that's really going, when's the next reversal going to happen on your particular currency pair that you're trading? The price goes up 20 or 30 pips, and then it has a short reversal, and it comes back how far? 10, 20 pips? And then it flips around and it goes up. It's that zigzag pattern of higher highs and higher lows as the price is moving up, or the reverse if you're on a short-term basis, short position basis. So in a 2-hour period of time, you sit down at your desk. Oh, there's a potential trade. You wait a couple of bars. Yep, that's it. Boom, and I'm in. You've got an hour or so to let that trade run. You've got an ATR of 5 pips. So if the thing is moving in your direction, you should be moving up 3 pips every bar. You should be seeing at least three pips of progress on every bar over that. So 3 pips profit every 5 minutes, you get 30 you get 30 pips an hour. So you sit there an hour and you hit your profit target. You make 20 pips. And it looks like it's starting to stagger at that point. So get out, and you make 15 or 20 pips. In doing day trading, you would like to get your 20 pips. You know that you're picking that profit target of 20 pips because that looks like the as far as order flow will allow and momentum will allow that price to get to. You're not expecting to get the full 20 pips. What can you expect to get? Well, it might take you a third of that distance to figure out that you've got a trade entry, and you may want to cut that trade short, a third of the distance to the profit target, just to make, because profit targets aren't points, they're zones, they're bands, right? And so you're losing 2/3 of that 20 pip distance, so you've got 6 pips that you are pretty sure you're going to be able to get. 6 to 10 pips out of that 20. Look, if you could make just 5 pips a day, 4 days a week, that's 20 pips a week. That's 80 pips a month. I just went through this calculation in the last video, I think. That's 800 pips a year. If you're trading one full lot and you make 800 pips, you've made $8,000. You made 80% return on your money. So the problem with the folks that are trading up on the longer term time frames is that they have to get 200 pips, 150 pips, 300 pips in order to justify the risk that they're taking and to compensate for the times that their stop is getting hit. I took a course from a very well-renowned trader, not some jackass that was just throwing shit against the wall. The guy was been on TV, for God's sakes, and he really knows what he's doing. And he's advocating 50 to 150 pip stops for 150 to 200 pip profit targets. This is not talking about what I'm talking about. I couldn't duplicate his system. A lot of folks couldn't. If you can duplicate the system and you can get in there, that's great. But as a short-term day trader, if I see that the price is going to continue on, it has a lot of momentum, it's going to go past my profit target, I can set a trailing stop. Boom, all of a sudden now I become a position trader, long-term trader. Correspondingly, if the price is starting to stagger, it just comes off my entry. I judged it, I got 20 pips to go, and it comes off the entry, and it starts to stagger after it moves 5 or 6 pips, and I get out. Now I'm a scalper. And but I want to scalp. I want to make at least 3 pips. I mean, if I can make 80% return on 5 pips, I come pretty close to that at 3. Well, it's 30% return, right? You make 3 pips on a $10 a pip, $10,000 account. You make $30 on that trade. You make 3 pips 4 times a week. That's 12 pips a week. 3 times 4, 12. Same process, and that's 48, almost 50 pips a month. 500 pips a year, taking a couple of months off. That's 50% money at 3 pips. But you have to know how to do it. So what I'm saying is that the ease of identifying a trade entry opportunity is much greater. It's simpler, which makes it easier. It isn't easy to trade, but it should be simple to trade if you're learning it the right way. And so by focusing in on that day trade position, I can make those decisions, I can get good experience doing that, and that gives me the experience and the confidence to say, oh, I got a real runner here, I'll put a trailing stop on there and I'll set and forget and go away. Or, this isn't looking the way I thought it was looking, and I'm going to get out right now. Now I'm a scalper, and I get out with 3 to 5 pips, or a break even. Or maybe it crunches and I lose 3 pips. I'm not going to lose 3 pips every day, 4 days a week, for a 50% loss on my money, right? Because I've got a win-to-loss ratio that comes into play here. I mean, I teach 4 metrics that we work on, and they all come into play in determining what you're going to do at trade entry. Your win-to-loss ratio, your average win value, your per-trade expectation value, and your return against risk. Those are the 4 metrics we try to help develop in the foundations class, that first foundations class that I have, course, which is part of there's 4 courses: foundations, principle-based trading, process-oriented trading, and advanced solutions. So that dealing with those metrics and all that kind of stuff, that's developed in that first course, that foundations course, because they're important. They're important in simplifying and making simple your trade entry process. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.